Good morning. Today is Wednesday, October 26th. I was trying to find my notes page to see where we're going to start, and we're going to start in England. Across the pond, Rishi Sunak right now is having his first prime minister questions, and he has delayed that big budget announcement that was scheduled for Halloween, October 31st. Now they have delayed that 2.5 weeks to November 17th. He's doing this because he wants his economic strategy to, quote, stand the test of time. He wants to get public finances on a sustainable footing, get debt falling in the medium term, and have a full forecast from the Office for Budget Responsibility. I think Sunak's playing this exactly right. I think he was actually lucky not to follow Boris Johnson. You never want to be the guy or girl who follows the bad leader, or at least a leader who ended their term in chaos. You didn't want to be Liz Truss following Boris Johnson. You didn't want to be after the Wells Fargo thing fell out. You didn't want to be that guy. You want to be Charlie Scharf. You want to be Larry Culp. You don't want to follow Jeff Immelt. Exactly. So I think it's a great move by Sunak to delay it, make sure that he has all of his ducks in a row, and be ready to deliver a strong and appropriate budget on November 17th. Tom?
Yeah, I think this is smart as well. He just seems a little bit more together, just from the limited amount of time I've spent researching him. He seems like a very sharp guy. Interested to see how this all turns out. You know, I thought it was interesting that Boris stepped aside really to let him kind of run in there uncontested, which is probably a good move rather than having a drag out. My hope is that obviously they can get this rectified and figure out the situation in England, because it's causing so many gyrations in the stock market and the bond market as well. You know, if we could just get that cleaned up, it would make things a little bit more navigable.
Speaking of the bond market had a great day yesterday. Interest rates fell, bond prices went up, and it does seem that the Fed is increasingly concerned about the consternation, especially in real estate, that its actions have been having. Nick Timiraos, the author from the Wall Street Journal, who really has Powell's ear, tweeted out this morning about the high level of mortgage rates, which isn't to say there's a top, but it does mean that if Timiraos is noting that, then Jay Powell is taking note of it also. Any thoughts on that as the interest rates start to come down here, or do you think that this is just a yet another fake Fed pivot?
I mean, I think that there's a lot of things going that direction. I think that ultimately the data is going to play out against it. There's an article yesterday morning about how Austin, Texas has tripled the amount of time it takes to turn over the inventory there in terms of the housing market. You know, it's pretty much universally considered the hottest housing market in the entire US. I mean, everybody from Elon Musk to Joe Rogan has moved there, and suddenly there's inventory. I think that the move the Fed might make, there's a couple of things that are kind of being talked about. One is that with the unwind of the balance sheet, potentially either slowing or stopping that, or moving it more to treasuries and not to mortgages, because the spread there is so wide. I mean, you can basically shift the entire runoff from, a mixture of mortgage backs and treasuries to just treasuries, and that may potentially close the spreads significantly between mortgage-backed securities and treasuries, which is historically wide. Additionally, there's talks about sort of what I would consider to be backdoor quantitative easing, which would be buying bonds through the Treasury and not through the Federal Reserve. The Treasury has cash on hand. They could potentially turn around and buy bonds, and they could manipulate interest rates.
Buying back its own debt.
Yes, exactly. Yeah, but it would be through the Treasury and not through the Fed, because technically that is not money printing. It's don't even know how to describe what that would be. That's the government buying. Yeah, it'd be a government debt buyback, or it could be like a company looking to buy back its debt, which would be probably accretive because the loss would be taken by the Fed, because the Fed bought at the highs and now the Treasury would be buying at the lows, and it could potentially it could increase the demand, promote liquidity, reduce the amount of interest rate expense for the government. But what that looks like, I really don't know, because that's not something that's ever really been done before, to my knowledge. But that is being floated out there as potential. Janet Yellen, I guess, has hinted at the fact that could be an option.
The problem with that is that you kind of have to run a surplus in order to do that.
Yeah, you have to. Yeah.
Otherwise, you just be buying bonds with other bonds.
You're just printing money in a backwards way. And so we'll see if that actually comes to fruition. It just seems to be sort of an internet rumor at the moment, but justifiably so, I think, because Janet Yellen has confirmed that is an option. So I guess it remains to be seen. I mean, Thursday we've got GDP. GDP comes in really hot right now. I believe the GDP now print is 2.9%, which is a strong number, really for any year. And so, that's going fly straight in the face of the Fed in terms of what they want to see. They want to see slowing economic activity. They want to see job losses. Though, if you look around this morning, there are a lot of companies that are talking about cutbacks. Seagate Technologies, I think, released a statement saying they're looking to cut 3,000 jobs. And so perhaps the original hikes that took place back in the early part of the year are now starting to kind of grip the economy, and we'll start seeing it rapidly filter through over the next month or two. We can see job losses really accelerate and economic activity really decelerate. But for the moment, the data is not showing that. And so I think the Fed doesn't really have a place to pivot unless they just decide there's just been too much pain in the stock market, in the bond market, in the mortgage-backed security space. But I don't see that being necessarily the case.
Yeah, I definitely think that, and we'll talk about this a little bit later in terms of the anecdotal evidence of a little bit more of a slowdown here among small and medium-sized businesses, and maybe even large companies too, depending on which company you are. Sticking with geopolitics, Saudis want higher oil prices. The energy minister there, Prince Abdulaziz bin Salman, said that, quote, people are depleting their emergency stocks and using it as a mechanism to manipulate markets, and that losing emergency stocks may become painful in the months to come. And it's a little bit of pot calling the kettle black in terms of manipulating markets, but OPEC does have all the cards, and it's makes one a little bit nervous when he makes a statement saying losing emergency stocks may become painful in the months to come.
Yeah, it sounds like a veiled threat, or
Exactly.
Not even a veiled threat, just a threat.
Yep.
Period.
So that's going to be something to watch going forward. Switching gears to individual company news, Meta is in damage control after Apple tightens the screws further. What has previously been the case is that Instagram people or TikTok influencers can pay to boost their post on social media. What Apple is now doing, and they can pay Facebook directly for that or TikTok directly for that. What Apple is now doing is, if you are posting to boost your standing on an app, you have to pay Apple a 30% commission, which ultimately is just going to come from Facebook or TikTok. Those are the ones who are going to have to pay it, because the influencers, that'll just be a market in terms of how much they're spending to boost it. So obviously companies like Meta do not like that. They say Apple previously said it didn't take a share of developer advertising revenue and now apparently changed its mind. And then they have this line: we remain committed to offering small businesses simple ways to run ads and grow their businesses on our apps. Just the word choice here: small businesses, simple ways to run ads. We're just looking out for the little guy. It's just, no one really sympathizes with Meta. I don't think, at the end of the day, no one's going to sympathize with them. I don't think anyone really sympathizes with Apple, although everyone knows the reality of in-app purchases. It's not really a surprise that Apple takes a cut. Tom, what are your thoughts?
We saw this with Fortnite, was like 2.5 years ago, when they started edging in on whether or not Fortnite could do in-app purchases or something. Somehow Apple was coming in over the top on Fortnite and taking money. And this is just them. When you're the biggest, baddest kid in school, you can give the other kids noogies. And that seems to be what Apple has decided they're going to do at every opportunity. And it's costing people a lot of money, not just Meta, but everyone else. Even if you think of like Candy Crush, which I believe is owned by Activision now, or one of the major video game companies bought them. So now any revenue going through that, suddenly ends up in the coffers of Apple, which is a wild move. But at the end of the day, they own the platform. Everything you purchase on your phone comes through that phone, and they're giving themselves the opportunity to wet the beak.
This co-opetition, as they call it, cooperation plus competition, works great when the market is going up and the economy is growing and there's money to go around. When the money starts to dry up, the big players look out for their own.
Yeah.
And you're starting to see Apple really throw Meta under the bus. Speaking of big players, Microsoft and Alphabet both reported earnings last night. Microsoft saw some significant deceleration in its cloud-based business, but PCs also just hit a brick wall in the month of September and are expected to be down in the 30% range in the fourth quarter. So Microsoft is dealing with that. I would actually say that I think Microsoft's probably taking the cuts now on the cloud business. What they're doing is actually they're working with customers. If you just type Azure Cloud Optimization, which is their cloud, the first 3 or 4 results on Google are Microsoft resources on how to reduce your cloud spend. So Microsoft is really working with their customers to optimize. They said that this builds loyalty over time. I think it's actually a smart move, especially because a lot of these customers would end up cutting anyway. So why not be the source of the cutting? And then you'll get the cloud business rebased and then be able to grow beginning in the March quarter. So I actually am a little bit more positive on Microsoft. Alphabet, though, on the other hand, doesn't really control as much of its own destiny. They're seeing a decline in the advertising market. They're also just seeing a decline in their user behavior in terms of how they're interacting, especially on YouTube, and what they're clicking on. You're just not seeing as many people actually follow through and actually click on things, which gets Alphabet the higher numbers. So both of those companies are under pressure today. Alphabet, we were talking about this last night. Twitter has 7,500 employees. Meta has something like 60, 70,000 employees, which is a lot. I don't know what they're doing all the time. Alphabet has 186,000 employees, and that's up from 130,000 employees a year and a half ago. That is insane. I would never have thought that they had that many employees. And according to the company, the vast majority of them are in technical roles.
And I believe they showed that they hired 12,000 people last quarter after announcing a freeze on hiring.
And they're only going to hire 6,000 next quarter.
Yeah. I mean, that's roughly 10% of the workforce of Walmart, which is one of the largest employers in the history of the world. And the weird thing is, I don't know anybody personally, I think, that works for Google. I mean, I suppose they're all both based on the West Coast or New York, but I mean, even so, that seems like an enormous amount of people for a tech company, particularly when compared to other, comparable competitors.
When you look at numbers like that, when you look at their operating margin, which is now down 750 basis points on a year-over-year basis, yes, they're at 24.5%. They were at about 32% last year. They're going to look for ways to cut costs at some point, and we haven't seen it yet. We're not seeing it next quarter, but I wouldn't be surprised if they start looking at that headcount and say, do we really need 186,000 employees in this company?
There's got to be some redundancy there, which
kind of furthers this narrative of the Silicon Valley / white collar recession. So that's something that we're going to continue to watch. Chubb, the insurance company, was hit by catastrophic losses related to Hurricane Ian. They're still seeing pricing growth in the 8% range, though. So not really too much of a decline on that stock yet. It's really dependent mostly on pricing. Texas Instruments, the big semiconductor company, they did note some weakness in the consumer, although they said that was expected. What they did say, though, is that they're seeing a little bit more weakness on the industrial side, where companies aren't buying as much inventory, or they're pulling down some of the inventory. The one bright spot they said was autos, which was up 10% last quarter, and will be up again in Q4. But everything else is a little bit in decline as this economic weakness becomes a little bit more broad-based. And then finally, we'll finish up with Visa this morning. And I'll toss it over to you, Tom, here on this in a moment, just in terms of how the company is managing things. But spending is holding up, and they say, we've been stable for more than a few months, probably close to the last 12 months. So we know that there's some substitution going on where people are buying generics versus buying brands. We know that people are spending an increased amount on food and drug products, and that's causing them to have less money available for discretionary spending. But we're still seeing the affluent customers jumping back in the market. and we're still seeing employment levels at a very healthy level. So they're not actually planning on a recession. They said they have contingency plans, but they think that their revenue is going to be up high single digits next year. And that includes headwinds from currency and the loss of the Russia business. So Visa actually in a fairly decent spot, but if this thing turns a little bit more, then there could be a little bit more way to fall for Visa. What are your thoughts, Tom?
Yeah, I think if you really kind of look through where the big numbers were, they're kind of things that could drop off exceptionally quickly. The big one, cross-border being up 36%. I mean, if things really start to crumble economically, people are not going to be traveling internationally. And, huge double-digit upside like that year over year can go away so quickly. I mean, we saw it with COVID. I mean, people will drop international travel at the drop of a hat, regardless of whether or not it's legal to do so. And I think that could be a big potential blind spot for them. But I mean, the numbers were good, and it definitely gives me optimism. But the more optimism we have, the more likely we are to get more Fed hikes, and therefore the more pessimism we might necessarily have to have.
Nassim Taleb, who's an author that Tom and I have enjoyed, particularly his early stuff. His later stuff has been a little bit wonky.
Yeah.
But especially on his early stuff, and he has a quote that says, "No shortage is ever not followed by a glut," which if you flip around that, every shortage is followed by a glut at some point, because it incentivizes excess production. We saw that with semiconductors. We saw that with a lot of things during COVID. Will we see that in travel? I guess that's the question. And that's something that we're going to have to be very attuned to as these shortages do become gluts and these gluts become shortages. That's just how the market works. So on that note, we'll leave it there. We'll be back tomorrow. Meta earnings tonight. So we'll have Facebook talk and probably lament Apple's additional fees. And then we'll also have the ECB meeting. We'll have GDP. So it'll be a busy morning tomorrow. Hope to see you there. Have a great day.